It's the Market Sniper, quick live stream. Haven't done that in a while. Glad to be with you. Here we are. Good to be speaking to you. And guess what's happening this week? Well, you got through OPEC. That was yesterday. Not too much happened on the oil price either way. A little bit upward drift, threats of production cuts, etc., etc. But the big interesting thing is, guess what's happening tomorrow? Yep, you guessed it. Your red hot labor market is coming to town, and you're going to get yourself a new number. And I'm here to tell you that Bidenomics has been brilliant. You don't believe how brilliant it is. Let me tell you, he has been a phenomenon. He has beaten 14 times in a row. 14 times. That's 14 months. That's actually more than a year, with just about another quarter about to be added on tomorrow when he beats the official number again. That's my prediction. That is unbelievable. Yes, this is such a red-hot labor market economy. You can't believe it. Or maybe you don't. Let's have a little look as to why you might actually think there's a little bit of stimulative product behind some of these rather fascinating and exemplary performance enhanced numbers. Yes, indeed. In fact, I'm going to cover a couple of things with you that actually will question the official narrative that you're getting about Bidenomics as a whole, and also about what's truly happening with your money. Is there really tightening? Well, I spoke with the gold guys yesterday at Franklin Mint. It was great fun checking in with them. We've got John Williams' shadow stats, and guess what it shows? Let's have a little look at what John Williams' shadow stats shows. Over here, are you really getting liquidity tightening? Is the Fed pulling in the rug and taking away the punch bowl, or is it merely pushing it out and lacing it with a little bit of powder to give you a little bit of vuma to your performances at this marvelous party of fraud that we are watching? Well, according to John Williams of Shadow Stats, go check out Shadow Stats' website to get his analysis of consistent, unbiased statistics on the economy. We're a fan. Seasonally adjusted, May 2023, money supply reflected continued Fed easing. Continued. It's not new. It's been happening already for a while. Easing, not tightening. So yes, rates are going up. That's one thing. But remember, the blood being slipped into the body to keep the zombie alive must keep this bloated, fat, toxic zombie alive. Keep feeding him cocaine up his nostril, adrenaline in his heart, and blood, more blood, transfusions. Get some kiddies from the White House that Biden probably has in a special little place. Squeeze the blood out of them and pump it into the zombie. We need more blood to go to his body and head. We must keep him alive. Keeping up appearances is what's actually happening. The FOMC appeared to flip its policy direction, says John Williams, back to easing, but in actual fact, they've just paused the tightening, in the tightening of rates, that is, the escalation in the interest rates. Liquidity is already consistently at the 34.8% high of both M1 and M2. So, in actual fact, there's plenty of liquidity being provided. There is being additional more. That means proliferation of dollars. Plus, good friends, we have the big interest rate bill. All these expensive rates are going to start coming due on bond debt. So you can expect lots of juicy interest rate payments required in the not too distant future, going from now, later half of this year into 2024, rolling even into 25, even if we were to start a cutting cycle, which I don't assess us to do, because we'll be referring to the bond market soon. And the bond market don't lie. Guess what? Buy, bond market go down, interest rates go up, and we'll be showing you that, not just on the US, but we'll even find the British. Remember that pension crisis? We'll check in on where those levels are too. So are you really in a tightening environment? By the way, I've got my my little old thing and toy here. Here you all are. Thank you for your comments. Comment right here. I will be watching, I will be seeing. I'll even put the spectacolars on there to not suffer too much blue light. We love wearing these. They save your eyes, I say, save your eyes. So we're looking at the Fed is lying to me, says the man. Yes, we're here to tell you exactly how much lying. We're here to tell you about all their skullduggery and nasty little affairs. Ooh, did you see this one? This seems to be all about the politicians. That is New Zealand Ardern. That is our friend Zelensky that you are sending shekels to. And of course, good old Hunter Biden. These are your politicians, my friend. The opiates for the masses and the party drug for the political classes. But let's keep it financial. So Danielle DiMartino Booth, featured regularly on our channel, actually says, why are restaurants full? The IRS news. Employee retention credit just hit new record. So what does that mean? Let's just, because this is the first thing, this might be the first time some of you are even hearing about this. So guess what this is? This is where, hey, it's kind of tough out there. We don't want all these companies retrenching all these people that then go into our unemployment number. Yes, we'll be talking about that ADP number, which, surprise, surprise, is a precursor to the live trading day that we'll be doing tomorrow, which will include the non-farm payrolls number. ADP is a payslip company, does lots of small and medium-sized businesses, does lots of payslip processing. It gives you an indication if new people are being added into payrolls or people are disappearing. And the ADP number was a massive, massive beat. So let's just cover the ADP number and come back to Danielle. ADP, expected 226. Massive beat, 500,000 on those stats, non-farm employment change. That is an early signal for what you might get on your bias for the number on Friday. What's the number on Friday? Friday, here it is. Average hourly earnings, non-farm payrolls, expected 224,000. Well, you expected 226 on ADP, and you got 500,000. These aren't small beats, by the way. Guys, in case you haven't noted, that's about 100% out. Why are all the bankers and the forecast people so bad at forecasting? Why are they lowballing all the time and making Bidenomics look so good? 15 times in a row tomorrow if it goes the way we're predicting. So far you are on 14. Let's just show you that in bigger form of this amazing beat of expectations that continues to occur. Let me get this in perspective here. Here we are. We're going to take you back to this last period since 22. Let's get that big fall away out the box and re-gird it. So let's count. Here was a miss. The gold tab is in fact a miss. Let's see if I can make that any bigger. Can we make that bigger? No, I blew it. Make it bigger, make it bigger. No. Okay, so you're gonna have to cope with me on that. The last miss was in April of 2022. If I show you with our little draw, these gold tabs are the banker's best guess. A beat, a substantial beat, an even more substantial beat, a beat. I am the beat. I am Biden. You are being beaten. You're being horrendously beaten. You are underestimating my brilliance at creating jobs. I am completely flooring all expectations. How many times? You guessed it. 14 times. 14 times in a row. What a brilliant president. They're already preparing the White House tweet to go out tomorrow. And again, once again, Democrats for the people. Of course, I'm not involved in the left versus right in any way. None of them work for you. They're all pals behind closed doors, giving you the heave-ho. Yep, I'm afraid that's the way it goes. So tomorrow, I'm expecting a beat. I said that before the ADP number in the community because we've kind of picked up the rhythm, you know. I've got the beat. I tell you what, Saturday night, out dancing, you and me, we'll show you we got the beat. But anyway, live trading day. What does this mean for markets? We will be digging deep and seeing how this affects the markets. But we've got a couple of things we have to keep in mind. Going back to Danielle's tweet. Let's cover the beat in the tweet. Let's have a look. Why are restaurants full? Asked Danielle. Employee retention credit. This is where you are a large business and you were thinking about laying off these people. You've got a lot of fluff. You were kind of hiring people to stop other people from hiring people because there's only so many tech devs. You've kind of had enough of project work to keep them semi-busy, and now you're not making the money you're supposed to be making, and you think it's time to lean down. No, no, says government. Don't practice sound business entrepreneurial policies. Keep the semi-welfare employees in the payroll system. We'll give you money. That's like someone showing up and saying, let us help you with your payroll. All you have to do is keep the number good. Keep the number good. Do you start to see the manipulation? Did you know, as taxpayers, did you know that you've gone from 5 billion in December 22, 5 billion in December 22, to a minor jump to 20 billion at the beginning of the year, January. That's quickly escalated, 15, 17, 23, whoops, June, 28 billion. How's that trend looking for you, friends? How's that trend? Let me just give you a clue. 5, 20, 17, 23, 28. What would you do? Throw a moving average on it if you want. Not me personally, it's plain enough to see. Trend bad, trend up on a bad thing. That's what called cocaine for the masses, for the labor stats. That literally is keeping people in jobs that should not be kept in jobs. Businesses keeping bums, keeping seats warm in a place where they're not doing much of any great productivity. In short, there is not only a support for the bond system, where the central bankers are buying up your bond market, they now own the employee market as well. They're starting to want to keep people in jobs. They're going to keep you. They're going to pay you, guys. I remember there's a great story from Milton Friedman. Let's take a little sidebar on this. Whilst you all look for that link for joining us for a bit of entertainment and a lot of market trading on our live trading day, click the link being shared now. Just what will you get? 197 to enjoy for a full month the recording, even if you can't attend tomorrow. And if you take the buy 2 get 3 for 3 months access to all the recordings, and you get to trade with us 3 hours, traditional markets for the first hour and a half, a nice break, and then again the crypto markets, all of which are very interestingly set up. I've got a lot to share, and the big number is coming, and the markets have gone quiet in anticipation. In short, there's going to be moves. When markets moves, there's money to be made, and there's money to be lost by those that don't know what they're doing. But anyway, you've got now a government spending money, taking your tax money, taxing you to keep someone who shouldn't be kept in a job by giving the company that's keeping him on a stipend to cover his wages. So he's got enough to do half a job, and the government pays the other half. That is also a form of manipulation of employment stats. Never mind the birth-death model, never mind everything else that is going on, never mind a complicit banking cartel that just can't guess for love nor money what absolute rubbish number is going to come out of the system, that they continue to understate what is clearly a bit of a misnomer. Never mind that also, apart from the methodology that does non-farm payrolls, there is a major and growing divergence in terms of surveys that show actual employment. In short, the one number is diverging from the others immensely. That means lies, damn lies, and statistics. It sets indeed the course for a Fed to claim red-hot labor market and still high inflation, because they're not really tightening. They may be pushing rates up, but they're not really tightening. They're easing. They've got to keep the banker flows done. There's too many derivatives, too many daily mark-to-markets to meet, my friends. The Ponzi scheme is at peak death. There's money to send to Ukraine, to someone else who likes a little bit of the old marching powder to keep his boys marching. Yes, you guessed it. There's lots of malfeasant expenditure that still needs to happen in this final orgy of corruptible expenditure and theft. Literally, people are stripping the assets off the walls on a soon-to-be burnt down house. You are watching the controlled demolition, my friends. This is a real opportunity to make money by investing in wealth, but it's going to be bad for most people. The reason you should attend tomorrow is the following: to understand the course and the direction of markets now, because there will be an extreme crisis which will see further collapses. Let's go have a look at those bond market charts and see what's going on down there. So here we go. We're striding off to the bond markets, and we're going to start off with the good old 30-year. This is a long-term debt machine. 30 years you hold this debt. And what's your take? Well, what's very interesting to me is we've always assessed it to be an upside HVF with a view that it's going to go back to 4.3%. That was down here when it was at 3.7, winding up. Boom, it broke over there a while ago. So from around about end of May, we were already warning that it was going to happen. Went into a falling wedge and calmed down a little bit. Has broken very resolutely. Notice suddenly in my Twitter feed, some of the smarter folk recognizing that the 10-year and the 30-year have begun an increase in rates. Remember, this is yield. Yield up means bigger interest rate expenses for you. Think about what higher debt cost does to an economy. Think about how many corporations are going to have even more employees they don't want to employ as they've got to pay the interest on their own debt. Many of the businesses, up to 15% at one point, were borrowing to pay dividends. Imagine that. You're not making enough profit to actually meet a dividend declared, or it's so much cheaper at the time that you elect to raise debt rather than give up your profits to pay dividends. And now, my friends, interest rates are now a whole different game. The cycle turned. They never saw it. The death knell, the rug pull, the mercantilist bankers, the tertiary extractors that always bring tidings of neighbors that wish to attack you, and it's time for you to arm up, and everything else, along with tertiary lending, where they will provide you with funds to do all and sundry at a marginal 100% per annum. Those guys, those very fellow, are about to rug pull the entire financial system. You are seeing interest rates up. You are seeing higher payments on cars, higher payments on houses. This is supposed to be an environment where the Fed has supposedly stopped rising. Well, the bond market says no. And guess what? The bond market is always right. The bond guys know before the equity guys. It's a much bigger elephant, friends. And most of you don't deal with it. Most of you don't watch it. But I'm here to tell you, here's the boss relative to equity markets and the Fed. If nobody is going to be putting a bid under the bond market and those yields are climbing, you have a liquidity crisis coming. And they will go from non-tightening, providing easing, to providing an absolute huge amount of easing, as you've seen before. What about that 10-year? Let's go see if it's any different. Cross the durations. Oops, that's the 10-year. That's a little bit perky. Well, you can see we already had upside HVFs with a target on there, and that target's now been made. I haven't looked at this chart today. Beautiful. Another trade made to the upside trading yields had you wanted to take it. That is the value of understanding it. And by the way, this also came as you took out this long-standing capping descending grind line that I've just shared with you right there on a nice little wind-up structure. And guess what? You are now at 4% plus 4%, approaching a localized high that only is beaten by the absolute high. So much for that. And if you want to be a technical analyst, friends, have a look at this. What do you see and think about that? Rounded it is. That is bottoming, not reversal. Bottoming. A nice rounded bottom. I almost start to feel stirrings below the belt line as I do that. There's a beauty to it all. Now, and let me tell you, that ain't no reversal. There's no transgenderism in here. It's a rounded, fresh, conservatively organic bottom for you to get excited about. The right kind. Okay, so that is debt and interest rates. What do you guys say? Are we really done with hiking? No, sir. No, sirree. You will be back to hiking. This is a turn. This is a collapse of the debt markets. At one point, it will get utterly disorderly. The reason you will show up for live trading day tomorrow is to understand this fact and to begin the process of preparing accordingly, to get a taster of what it means to be a member of our community, to get a taster of how you should be positioning, so that you too eventually someday can come and watch, be part of our self-study program, and then participate on Sundays, or maybe become part of our TMPs. And what's the risk to you? The value of $197. You'll be entertained alone for that and more. And you will find out what's capturing our eye in the crypto markets. You will find out what's capturing our eye in the traditional markets, equities, FX, who's the movers, the trades you should have on, all of that, and you will see the data come in what's been a low volatility week, which could just begin exploding. And we know how we're biased for these numbers. Let's have a look at some of the questions here. Hiking into a recession because they didn't raise years ago. That's dumpster bear. I agree with you. They should have been raising a lot sooner. They were late. It was transitory. Of course. Let me just be clear. Inflation is policy for central bankers. Inflation is not something they fight, it is actual policy. And they've pretended that this is all accidental, that this happened. They pretended it didn't happen because they needed it to be bigger. Why did they need it to be bigger? Because they need to devalue in real terms the huge amount of debt that they are creating. This is a scam game. This is a pantomime you are watching. Or we're deeply concerned about the cost of living for the poor. Like hell! They don't give a damn for the poor. They want to see you squeeze. They need you on their welfare programs. That entrenches government in a role and a job. They don't give a damn. They actually want it. They want to see the poor suffer. They need to weaponize an angry mob. This is what they want. You are here right where you are because that is how they want it. Until you realize that, you haven't learned a goddamn thing. And I'm here to tell you all about it. I'm here to educate you on these things. And I'm here to tell you how you can protect yourself against that, how you should be positioning, how you should be trading it. All that and more on the link that's coming. I've got so much more to share with you, but that's it for this quick stream. Get with the program. Come and join us live trading tomorrow for either 3 for the price of 2 or 1 visit. The links are being shared right now. Come and be part of us. Watch what is going to move and save you from an inflationary force that's going to see a potential spike in interest rates coming that is going to cause ructions in currency markets that will be the reason and justification for a new, more equitable financial system. That, according to Fink, will see you all in blockchain with identified beneficial owners. In short, tax extractors know who you are, where to come, real-time taxation on your blockchain. That is their plan. They have set their trap. How are you going to end up falling in it? Or will you transcend beyond, my friends, in wealth, freedom, and so much more? We're here to help you with the ladder. Until we see you next time, thanks for coming on. A big salute to you all. We look forward to seeing you on the live trading day. Now, links below. Click and see you then. Bye for now.